Hello, I'm Haider Malik, host of the Mehmi Financial Group podcast. Today's topic is rate hikes and opportunities timing your equipment loan in a shifting market. Rising benchmark rates increase borrowing costs, but smart timing and structure can still secure favorable financing. Here's how to navigate a tightening cycle. 1. Know the cycle. Tightening versus easing. Central banks raise rates to curb inflation, then pause or cut when growth slows. Tracking policy statements, inflation data, and yield curves helps anticipate moves. Spreads and floors. Lenders add a margin over prime. They may enforce a spread floor, minimum, and cap your maximum rate. 2. Fixed versus floating. Fixed rate loans. Lock today's cost and shield you from hikes but include a premium, often plus 0.250% over floating. They work well if you expect multiple future increases. Floating rate facilities. Start lower but rise with each benchmark hike. They suit businesses anticipating cuts within 6 to 12 months or those with tight cash flows. 3. Loan structure strategies. Caps on floating. Add an interest rate cap to limit your maximum rate. You pay a small upfront premium, e.g., 0.25%, but participate in any rate drops without full exposure to hikes. Split financing. Borrow 50% fixed and 50% floating with a cap. This hedge balances stability and potential savings if rates retreat. Bridge to fixed. Use a short-term equipment line of credit to fund initial needs at a floating rate, then refinance into a fixed loan once rate peaks are clearer. 4. Timing your lock-in. Before major hikes. If markets forecast 50 to 100 basis points of increases over the next 6 to 9 months, locking a fixed rate now, even with a modest premium, can save thousands over a multi-year term. After a pause. When central banks signal a pause, consider floating with a cap, expecting cuts within the next cycle. Pre-easing window. Historical data shows cuts often follow 2 to 3 months after a last hike. If you see early signs, slowing CPI or GDP, you might delay locking or cap only the upside. 5. Quick action steps. 1. Assess your need. Determine exact timing and amount for your equipment purchase within 3, 6, or 12 months. 2. Gather market intelligence. Monitor central bank releases, swap curve steepness, and inflation surprises. 3. Request quotes. Ask lenders for fixed rate term sheets, floating with caps, and split structure proposals. Compare all in costs, including cap premiums and swap fees. 4. Model scenarios. Simulate debt service under plus 50 BPS, plus 100 BPS, and then 50 BPS. Evaluate cash flow impact and covenant compliance. Key takeaway. In a rising rate environment, timing and structure matter more than ever. By choosing the right mix of fixed, floating, caps, or hybrids, and by acting when policy signals change, you can lock in competitive equipment financing and protect your cash flow no matter which way rates move next. I'm Haider Malik. Thanks for listening.